How fast can you really retire with $1 million? Today you will understand the real plan to achieve that goal within 10, 20, or 30 years. My friends, please understand this. There's one number that can dramatically change how difficult your retirement goal becomes, and most people have never actually calculated it for themselves. It's not your credit score, and it's not even your salary. It boils down to how much you need to consistently invest based on the amount of time you have left. I'm Rich from Retire Smarter, and today we're going to take one goal, building a $1 million investment portfolio, and run it across 3 completely different timelines: 10 years, 20 years, and 30 years. And by the end, you're going to see why time may be one of the most valuable assets in your entire retirement plan. Let's make this real. Meet Maya. She's 33 years old, she has a steady job, and until recently, retirement was basically a vague, someday idea. She knew she should be saving. She knew investing mattered, but she had never actually worked backward from a specific number. So she asks a question. What would it actually take to build a $1 million retirement portfolio? Now, before we go any further, there's something important we need to establish. $1 million is not a universal retirement number. Whether $1 million is enough for you depends on your spending, retirement age, taxes, healthcare costs, Social Security, other income, how long you live, and how your money is invested. But $1 million gives us a clean target that lets us see something incredibly important. What happens when we change the amount of time available for compounding? And there's another reason people often talk about $1 million. There's a famous retirement guideline commonly known as the 4% rule. The basic idea is that someone beginning retirement with a diversified $1 million portfolio might withdraw roughly 4%, about $40,000, during the first year, and then adjust that dollar amount over time for inflation. That's roughly $3,333 per month in the first year, before considering taxes. But here's an important distinction. The 4% rule does not mean your portfolio will simply earn more than 4% every year and automatically replace whatever you withdraw. Markets don't work like that. Some years are strong, some years are negative, and experiencing major losses during the first several years of retirement can have a significant effect on how long your money lasts. That's why the 4% rule should be treated as a planning guideline, not a guarantee. In fact, current retirement research puts a sustainable starting withdrawal rate somewhere around that neighborhood depending on the assumptions used, and someone retiring extremely early could potentially need an even more conservative number because the money may have to last 40 or 50 years instead of 30. So we're not saying hit $1 million and you can automatically retire. We're asking a different question. How much would Maya have to invest to build $1 million? And this is where time becomes incredibly powerful. For all 3 examples, we're going to use the same hypothetical 7% annual return, compounded monthly. That's an assumption for illustration, not a guaranteed investment return. Actual markets will move up and down, investment returns will vary, and fees and taxes can affect the final result. But keeping the return assumption identical allows us to isolate the one variable we're trying to understand: time. Let's start with 30 years. Maya is 33 today. If she gives herself 30 years, she's aiming to reach the $1 million mark around age 63. Assuming that hypothetical 7% average annual return, she would need to invest approximately $820 per month. That's about $27 per day when averaged across the year. Now watch what happens. After the first year, Maya would have roughly $10,000. Nothing spectacular yet. That's because compounding starts slowly. After 10 years, however, the account would be around $142,000. After 20 years, it would be roughly $427,000. And by year 30, it reaches approximately $1 million. But this is the number I really want you to see. Over those 30 years, Maya contributed only about $295,000 herself. The remaining roughly $705,000 came from investment growth in this hypothetical example. For every dollar Maya contributed, investment growth added roughly another $2.39. That's the power of giving compounding 3 decades to work. But suppose Maya doesn't want to wait 30 years. Suppose she wants to reach that same $1 million goal in 20 years. Now the math changes dramatically. And notice what we're not going to do. We're not going to assume Maya can magically make the market return more simply because she wants the money sooner. We're keeping the exact same 7% hypothetical return. With 20 years instead of 30, Maya would need to invest approximately $1,920 per month. That's about $63 per day averaged over the year. Look at that difference. Cutting 10 years from the timeline didn't increase her monthly investment slightly. It more than doubled it. After the first year, she'd have roughly $23,800. After 10 years, approximately $332,000. And after 20 years, she reaches approximately $1 million. But now look at how much of that million came directly from Maya. She contributed approximately $461,000 herself. Investment growth accounts for roughly $539,000. So in the 30-year version, the market did substantially more of the work. In the 20-year version, Maya has to carry much more of the load herself. Now let's go to the version everyone wants to hear about. What if Maya wants $1 million in just 10 years? This is where the numbers get serious. Using that same hypothetical 7% return, Maya would need to invest approximately $5,778 every month. That's roughly $190 per day averaged across the year. Now, we're clearly not talking about cutting out coffee or canceling Netflix. This requires substantial income, a very high savings rate, or both. After 1 year, she'd have approximately $71,600. After 5 years, roughly $414,000. And after 10 years, she reaches approximately $1 million. But look underneath that final number. Maya personally contributed approximately $693,000. Only about $307,000 came from investment growth. Compare that with the 30-year plan. 30 years, about $295,000 contributed. About $705,000 from hypothetical investment growth, 20 years. About $461,000 contributed. About $539,000 from investment growth. 10 years, about $693,000 contributed. About $307,000 from investment growth. Same $1 million destination. Completely different journey. And here's the part I think changes the way you look at retirement investing. In the 30-year plan, every dollar Maya contributed generated roughly $2.39 of additional investment growth. In the 20-year plan, every dollar she contributed generated about $1.17 of growth. And in the 10-year plan, every dollar she contributed generated only about 44 cents of growth. That's what shortening the timeline costs. Not because the market punishes you for starting late, but because compounding needs time. The longer your money remains invested, the longer previous gains have the opportunity to generate gains of their own. That's why starting earlier can sometimes matter almost as much as contributing more. But there's one more reality we absolutely cannot ignore. Inflation. $1 million 30 years from now will not have the same purchasing power as $1 million today. If inflation averaged 2.5% over those 30 years, for example, $1 million 30 years from now would have purchasing power roughly equivalent to about $477,000 today. That's not a prediction of future inflation. It's simply an illustration of why retirement goals need to rise over time. So if Maya means, I want the future equivalent of today's $1 million, her eventual target would need to be substantially higher than $1 million. That's one of the biggest mistakes people make when they run retirement calculators. They calculate a future dollar amount, but mentally picture what that money buys today. Those are not the same thing. And the same caution applies when we talk about withdrawing $40,000 from a $1 million portfolio. 30 years from now, $40,000 won't necessarily buy what $40,000 buys today. That's why good retirement planning doesn't just ask, how much money do I want? It asks, how much income will I need in future dollars to support the lifestyle I want? Social Security may eventually supplement that income as well. For context, the average retired worker Social Security benefit in June 2026 was about $2,084 per month. But your own benefit can be significantly higher or lower depending on your earnings history, the age you claim, and the Social Security rules in effect when you retire. So Social Security should be part of the calculation, not treated as a generic check everyone receives in the same amount. Now step back and look at the bigger lesson. There isn't one correct lane. Someone with 30 years has an enormous advantage: time. Someone with 20 years can still build substantial wealth, but they'll generally need to contribute considerably more. Someone trying to accomplish the same goal in 10 years is asking their paycheck to do much more of the work that compounding would otherwise have done. And here's another mistake I don't want you making. Don't hear the 10-year example and think, well, I'll just invest more aggressively and make 12% instead. Higher potential return generally comes with higher risk, and higher risk does not guarantee higher returns. In fact, when your timeline becomes shorter, a major market decline becomes more dangerous because you have fewer years available to recover. Your investment mix should be based on your goals, time horizon, financial situation, and tolerance for risk, not simply the return you need in order to make a calculator produce the number you want. So here's what I'd actually do after watching this video. Don't start with $27, $63, or $190 per day. Start with your life. How much do you already have invested? How many years until you want the option to stop working? How much do you expect to spend? What other income might you have? Then calculate the portfolio you'll realistically need and work backward from there. And if the number feels impossible, don't automatically give up. There are several variables you can change. You can save more. You can work longer. You can reduce your expected retirement spending. You can increase income. You can make sure you're taking full advantage of employer matching where available. And sometimes moving the finish line only a few years can dramatically reduce how much you need to contribute each month. That's really the lesson here. Most people focus on finding the next investment that's going to make them rich. But one of the greatest advantages available to an investor isn't a secret stock, a complicated trading strategy, or predicting the next bull market. It's time combined with consistent investing and compounding. 30 years gave Maya's hypothetical investments enough time to generate more than twice the amount she contributed herself. Cut that timeline to 10 years, and Maya had to personally supply almost 70% of the final million. Same goal, same assumed return, different timeline. Completely different amount of work required from her paycheck. So here's the question I want you to answer. If your goal were $1 million invested, which lane are you realistically in right now? 10 years? 20 years? 30 years? Drop your answer in the comments, and if this kind of retirement math is useful to you, subscribe to Retire Smarter. Thanks for watching. I'm Rich from Retire Smarter. See you in the next one. Be blessed. This video is for educational and entertainment purposes only and isn't financial, legal, or tax advice. Maya is a composite illustration, not a real person, and specific dollar figures, yields, and tax figures are simplified examples, not personalized projections or current guaranteed rates. Talk to a qualified professional about your own situation before making an investment decision. Thanks again for watching. I wish you peace and prosperity. Rich out.